What's up guys, welcome back to the channel. Today we're going to talk about smart money concept. Smart money concept is one of the best trading strategy you can use to make money in the financial market. There are a lot of trading strategy which you can use to make money as a trader, but smart money concept is a strategy I trade with and I make money trading with this particular strategy. So this is what I'm going to show you in today's video, how you can actually make money from the financial market by trading with smart money concept. So let's jump straight into it, but before that, if you're new to the channel, consider subscribing to the channel and be part of this family. So let's jump straight into it right now. So for this strategy, if you want to trade this strategy, what you're going to need is you're going to need the 2 hours time frame. Another thing you should keep in mind is that you have to understand top-down analysis. If you don't understand top-down analysis, I will still ask you to spend some time in understanding how to read market structure across different time frames. Okay, so another thing you need to identify is the order flow. Okay, identify the order flow, so know if the order flow is bullish or the order flow is bearish. So if, as you can see from here, the order flow is bullish. For this particular example, the order flow is what? The order flow is bullish. Now, what else do you want to see? You want to look for an institutional candle. So what are the characteristics of an institutional candle? Firstly, an institutional candle usually move with large body candles, or you see series of candles. Okay, so for this, in a bullish example, you might see candle moving with a large momentum, or you see series of bullish candles, okay, moving to the upside. So that's an institutional candle. But the most important characteristics of an institutional candle is that it must break structure. So from this area right here, you see the candle moved from this low and it broke structure to the upside. So this is the very first thing you should understand. Okay, an institutional candle should move with candles with large bodies, and another thing it should do is that it should break structure. That's very important point. So you see this candle that moved from this particular low to this high, you see that it broke structure to the upside. So this is a very important point you should note. Another thing you should note is that an institutional candle should have a fair value gap. It should leave a fair value gap that needs to be filled at some point. Okay, that's what you should note. Then what else do you need to do when you identify an institutional candle that breaks structure and it has a fair value gap? Another thing you should note is that you should select your point of interest which you'll be trading from. Okay, so go ahead and select your point of interest. Your point of interest could be your supply and demand zone, or you could trade from your bearish or your bullish order block. Your point of interest must be at discount or premium level. You have to measure with your Fibonacci tool from the low of here you're looking to trade to the high. So anything below this level, you see this 50% level, anything below here is your discount level, and we usually buy from a discount level. So if price comes down to a discount level, you will look to buy and trade to the upside. But if price is at your premium level, you can look to sell from that area. Okay, so these are the rules of this trading strategy. So let me explain this quickly and show you example. So from this area right here, what you can actually see is that price forms a high, push to the downside. We have this low, price pushed a little more and it forms an equal low right here. Okay, you see that price forms an equal low. Now you see price push a little pullback and we have a break of structure, which is a valid one. So anyone that is looking to trade, remember the rules I said to you. Identifying the order flow. Now we've seen the order flow is bullish, and some people might look to identify this as an institutional candle, which is also right, because we might have a fair value gap and the candles that broke structure might have momentum, that is, it might move with large body candles. Okay, but if you're trying to select your POI right here to trade, it's not going to be a very good one. Why? We have equal lows right here. We see price forming equal lows. So equal lows are part of liquidity, because this might be some kind of accumulation and this is an equal low. So trying to trade from here is not a good one. But in this case, what do we see? Price comes back, sweeps the equal low before seeing a push to the upside. So you have to train your eyes and you should be able to identify liquidity areas in the market, because if you try to trade from liquidity areas, there is a possibility that you're going to lose money trading from that kind of area. So we have equal low and we see equal lows as a type of liquidity. Okay, but what do we actually see? Price comes, sweeps the liquidity, price takes the equal low and a push to the upside. But if you wanted to get involved in this particular trade, what you should do is immediately price sweeps the liquidity at the equal lows, you can drop to your lower time frame, maybe time frames like the 5 minutes time frame or the 3 minutes time frame, and look for a market structure shift. Then you can look to trade in direction of the order flow. Okay, this is what you can actually do. Instead of trying to trade from this liquidity zone, you can wait for price to firstly take the liquidity below this area, then you can drop down to your lower time frame, look for a market structure shift and trade to the upside. Okay, so what do we have? Price takes the low, and now we see price push to the upside with momentum. So this is an institutional candle if you want to identify that, because why? We have a break of structure. Maybe in a live chart or in a live example, we might see price leaving an imbalance, which makes this an institutional candle. So when you identify your institutional candle, as we've seen in this particular area, you can go ahead and mark out your point of interest. So in this case, you might identify your order block which you might be looking to trade from. Now that we have a break of structure, there is another way you can actually get involved in a trade, and that's why I said you should have understanding of top-down analysis, because with top-down analysis you can actually get involved in a trade before price comes back to your order block, which is a valid place to trade from. You can actually look for another trading opportunity as price comes back to this point of interest. And how can we actually do that? How you can actually do this is when price breaks this high, you see this break of structure. Yes, price took this high, you have your point of interest below here. Now what you can actually do is you can drop to a lower time frame to look for a market structure shift, because you've identified that your order flow is bullish. Yes, we are in a bullish trend, but anytime you see price takes an old high and it's obvious that price took this buy side liquidity, there is a possibility that we're going to have a pullback. So even if price pushed with momentum to the upside, at some point we're going to see price pulling back to the downside. So what you can do is you can drop down to your lower time frame to take a quick trade. So what you can actually do is that you can identify a market structure shift, because in this case you see price takes this particular high in form of a break of structure. Now you see price push down, takes this low, which is a market structure shift, which a lot of people call a change of character. And after that, what can you actually do? You can look for a lower time frame point of interest, which you can actually trade from. Okay, once price comes back, taps into that zone, you can look to trade to the downside. But you have to listen to this advice I want to give you. This is a lower time frame trend. Okay, this trading opportunity you're looking for right here, this is a lower time frame trend. At some point price might pull back a little and continue to the upside without actually getting to this area to mitigate your point of interest, right? So what do you want to do? What you want to do is you want to take a quick trade. You can actually target this low right here, or you target this particular one right here. You might not actually wait for price to get to this particular points of interest. Okay, so when you have a change of character and you get your entry right here, what you should do is that take your trade, take your profit right here, or you take your profit right here, or you do it according to your risk to reward ratio. So if your risk to reward ratio is about 1:2 risk to reward ratio, 1:3, or 1:4, it's okay. Because another reason you should take this particular trade, another confluence, is that if you measure with your FIB2 from this low to this particular high, what you're going to note is that price is at your premium level, and you can actually decide to take your profit at the equilibrium level. If you take your profit right here, it's still okay. And this is another advantage you have. Remember, you sell from a premium level and you buy from a discount level. So at this point price is at your premium level, so selling from this point, if you have a very good trading opportunity, is still a good one. So that's it. So continuing, what you can actually see, after we got an entry, price pushed to the downside, now price comes back to mitigate this point of interest. Okay, so price comes, mitigates the point of interest, and now we're getting a push to the upside. So just like I explained, another thing you can actually do once price comes here, if you missed the first entry, what you can actually do is you can drop to the lower time frame to get more involved in this particular trade opportunity. Because from here, what you can actually see, price pushed into the zone, a push to the upside. Now you see price kind of mitigates this zone right here, gives a little reaction, now breaks above the zone, we have a little pullback, and now we have a break of structure. Okay, we have this pullback, and now price breaks structure to the upside. So what you can actually do is you can look for other way to trade in continuation of the trend. The order flow is bullish, so you can actually look for a trading opportunity so you can trade in continuation of the trend. Okay, so if you're totally new to smart money concept, this is not what you're going to master in a day. Smart money concept is a little bit complex and you can't master it in one particular day. So what you have to do is you have to take your time, learn more, and dig deep into smart money so you will understand every single thing. Okay, so instead of still waiting for price to get this high, take this high before you start looking for trading opportunity, so when you are on the lower time frame, you can get involved in a trade, because price will be breaking internal structures on the lower time frame. Okay, price is going to break internal structures, and price is going to give you other trading opportunity, but in another sense, those trading opportunity is going to be an internal liquidity area which price will come back at some point to sweep. Price will come back at some point to sweep those internal liquidity area. Now we might have a point of interest, then price will come back once more to mitigate that point of interest, then go for external range liquidity. Okay, so this is it, and I hope you understand exactly where I'm driving to. So let's move to the price chart. Let me show you a live example. And for a bearish market, this is just the flip of this. I don't want to waste time in explaining this for long. Okay, so for a bearish market, it's just the flip. So let's move to the price chart right now. So this is Euro AUD price chart, and I'm going to use it to explain further so you understand better. Remember, I said we're going to be using the 2 hours time frame, and we're on the 2 hours time frame. I said you should identify the order flow. Now if you look, you can clearly see that the order flow is bullish. Price has been pushing to the upside, so the order flow is bullish right here. Okay, now what I said is that you should look for an institutional candle. So just like I explained, what does an institutional candle look like? You see this particular candle right here, this candle that moved with momentum, a little pullback and a continuation to the upside. This is an institutional candle. Why? Price broke structure. You see price breaking these internal structures, and you see the body of the candles, and it equally has an inefficiency. You see this large imbalance that needs to be filled. So this is an institutional candle. So now price pushed the upside, a break of structure and a pullback. So just like I explained, why did price takes this low? We have equal lows right here. We have equal lows, and equal lows, we see this as liquidity areas. Okay, it could be another type of smart money trap. Now at this point, instead of price to mitigate our zone, mitigating this low, what do we actually see price do? Price comes, sweeps the low, and we see a push to the upside. At this point, you can actually drop down to the lower time frame to get your entry. If you want to take a trade from here, you can actually drop down to your lower time frame to get an entry that you're going to push price to the upside. So in this particular case, price pushed the upside. We have a break of structure. So this is our institutional candle. This is an institutional move. Okay, you see multiple bullish candles pushing to the upside. We have a little slowdown right here. You see at this point, price slowed down a little. Finally, we have a break of structure to the upside. So this push, this institutional move broke structure to the upside, which is a valid thing, and this is what you want to see price do. Price breaking structure to the upside. We have an inefficiency right here. If you look closely, we see we have a break of structure to the upside, and we can go ahead and select our points of interest. And this point of interest right here, this candle that swept this low, it's a very good place to trade, and you can agree with me that this price is at a discount level. Now this is our point of interest, and this is where you're going to look to trade from if price comes back to this area. So this point of interest is kind of large, and you can actually decide to refine this point of interest depending on the way you refine your zone. You can actually decide to refine it, but for the purpose of this example, I'm going to leave it this way. Now we have a push to the upside, and what I said you should do is that you should go down to the lower time frame to look for a market structure shift which can allow you get involved in this particular trade opportunity. So if you look, we have an internal break of structure right here, and now price takes this high. We have a pullback. Did price take the low? No. Now price moves to the upside, and now we have another break of structure to the upside. Now if you want to get involved in this trade, where do we want to see price take? This low right here. So if price takes this low, we're going to look for a point of interest where we're going to look to trade from. Okay, so let's play price forward, and now you see price continues pushing to the upside. We have a more clean push to the upside over here. Now playing price forward, now price is pulling back a little. You see price takes this particular low over here. Now that price takes this low, you can identify this as your market structure shift. You can call it a change of character, or you label here your market structure shift. And if you look, we have a very good institutional candle. You can see this candle, how it's pushed with momentum to the downside, breaking this particular low, giving us this market structure shift. And you see it has a lot of imbalance, which makes it a valid one. So what you have to do is you have to select the candles that swept this high as the zone which you'll be looking to trade from. If you look closely, we have this candle right here. This is the zone which you'll be looking to trade to the downside. Okay, now let's see what we have. Now price push to the downside a little more, continuation to the downside, and now we're getting a pullback, and finally price mitigates this zone. You see that price mitigate this zone. So instead of just waiting for price to come back and mitigate this your point of interest, you can look to take this trading opportunity. But remember, you're going against the trend. This is more like a counter trend, going against the trend, and it's not always advisable to do that. So you only do this if you are experienced and you understand multi-time frame analysis very well. Okay, that's why I said at the beginning that you should learn about multi-time frame analysis. And why are we taking this particular trade? You see this zone right here, this point of interest is at a premium level, and we look to sell from a premium level. Now you see price taps into this point of interest, and we're getting a reaction to the downside. Okay, you see price push to the downside till it gets to this our point of interest right here. Remember, we have this initial point of interest. So when you got your entry right here, what you could actually do is you could go ahead and look to target this particular area right here. This area could have been a good target, or you look to trade till price gets to this area, but you'll be very careful in managing your trade. You should be very good in trade management if you want to hold till price gets to this particular level. Okay, now price comes back to mitigate the initial level we had as our point of interest, and if you want to get a lower time frame entry, you can go drop down to the lower time frame to look for a lower time frame entry. And if you don't know how to look for a lower time frame entry, I'm going to link the video in the description so you watch it after. Now price mitigates the zone, and we're going to expect a continuation to the upside. But what you should also keep in mind is that we have this point of interest right here. In most cases, we usually see price coming back to mitigate or react a little bit from this kind of point of interest. This is what I've noticed from experience. Now playing price forward, what do we actually see? Price push to the upside. It didn't actually get into the zone, and now you see it taps in a little reaction, and you see price pushing to the downside. So if you're looking for a lower time frame confirmation, you see you got a very good one, because over here we see an internal break of structure. That's if you move to the lower time frame, because this is also an institutional candle. If you drop down to the lower time frame, you see how it's moved with candle with large body. So this could have been a very good area if you wanted to get your lower time frame entry. So you gonna look to trade to the upside, and at the same time price mitigating this unmitigated zone right here. Now you see price pushed a little more, comes back to that zone, and you see a continuation to the upside, breaking this particular high. Now if you want to trade from here, you see we have another institutional candle that broke structure. You see price break above this high, and it broke an internal structure right here. Okay, so what you can actually do is you can actually wait for price to come back to this bearish candle, so you get another entry and get involved in a trade. So this zone is large, but it can also be refined, okay, based on your personal preference. Now price continues to push to the upside. Now it comes back, mitigates this zone, and you see that continuation to the upside, and now you see price breaks an internal structure again. So this is how you can actually trade with smart money concepts. I didn't say you should go about looking for trading opportunities like this. What you can actually do is you can wait for this first zone you have right here, which is a very good one, and you can actually trade from this one right here if you're opportune to get a lower time frame zone, and this is what I call a confirmation entry. If you are opportune to get it, it's a very good one, and this is what I love to see, because once you get a lower time frame entry, entering from a lower time frame zone, you're going to make a lot of money. This might actually offer you close to 1:8 or 1:10 risk to reward ratio. Okay, it might offer that kind of trading opportunity, but this is what we want to see. Moves like this, and over here what do we see? Price takes this high right here. Okay, you see price takes this particular high. So where could be a possible place you could look to enter? This zone right here could be another place you could look to enter your trade if price comes back. But in this case, what do you see? Price continues to push to the upside, didn't have any retracement at this moment, but in this case price has continued to push to the upside. And one thing you should keep in mind is that this is price building liquidity. You see price has been respecting some kind of lower time frame zones over here. So this is a kind of liquidity, because what we know, at some point price is going to come clear this trend line liquidity, and it's going to come look for another point of interest, which we're going to get involved, and we have a continuation to the upside. Okay, so that's it, and I hope you understand exactly what I just explained in today's video. Okay, I hope you have a better understanding of how to trade with smart money concept. Smart money concept is a very good strategy, and this is what I teach on this channel. So if you want to learn more about smart money concept, I will advise you to hit the subscribe button, because you'll be getting more of this. Okay, if you ask questions, I can actually reply and help you understand if you're confused in anything. So that's it, and I hope you understand exactly what I just explained. Thanks very much, and see you in the next one.